Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures. Hello, everyone, and welcome to this edition of Macro Minutes called Bark or Bite, which we're recording on January the 14th. In the first 2 weeks of 2025, markets have extended the moves from December. We've seen higher bond yields, steeper curves, strong dollar, higher oil, and equities have softened a little bit. On today's call, we have four macro experts, Blake Gwinn, Peter Schaffrik, Elsa Lignos, and myself, to unpack the key implications across a wide range of topics. We have a lot to cover in this episode, so let's get right into it with the elephant in the room and the global gravitational pull in the bond market. Blake, you've updated your Fed forecast recently and have at least one controversial nugget in there that you flagged back in November. So, what were you thinking before the last change, and what are you thinking now?
Well, yeah, just as a reminder, Jason, we've been on the hawker side for quite a while. We've had a 4 to 425 terminal call for quite some time, expecting a final cut in January. But that call was already on very thin ice following the hawkish December Fed meeting. I thought there was still kind of a possibility that Powell, him leaning more dovish than the committee, may have been able to build a case on the data that we saw between the December meeting and the January meeting to cut again. But quite simply, the data just hasn't given any cover to cut again. Particularly the December NFP last week came in very strong, and I think coming from the Fed, we've just heard Fed speakers repeatedly kind of emphasizing these words like cautious, gradual, careful, and really suggesting that they're looking to slow the pace of cuts. That was kind of culminated in the release of the FOMC minutes last week, which made it pretty clear that a substantial majority on the Fed think they're well positioned to, quote, take their time in assessing the outlook. So it just seems like they are setting up for a cut, and there might have been a possibility, setting up for a pause. There might have been a possibility that the data gave them some excuse to get one more cut in, but at this point, it doesn't really look like that's going to be the case.
Blake, we've seen persistent and substantial bear steepening since the start of December, and the conversations around this move seem to have been circling around two major themes. One, that it reflects growing concerns about deficits and treasury supply, and two, that the Fed is making some kind of dovish policy error and that inflation expectations are starting to push up long-dated yields. What's your take?
So, I have certainly heard those themes. I think there's been a lot of discussion, a lot of questions coming in along those two fronts, throughout this back-end-led sell-off. I think both of those are probably, to some degree, retrofitting a narrative onto the price action. If you look at some of the other places you would expect both of those themes to show up in price action, meaning looking at asset swaps, which should move on deficit expectations, looking at longer-dated inflation expectations that should be rising. If the Fed was seen as kind of losing control or being stubbornly dovish, those things aren't really moving the way that I would expect if those themes were what was driving the sell-off. So instead, I think what we're left with, I think for one, we did have a lot of supply to start the year. So markets were having to absorb not only treasury issuance, we had a round of long end auctions, but also a lot of IG issuance coming to the market. So that probably kept some upward pressure on yields. I think there was some pressure coming from overseas. So some of this wasn't even necessarily a US story. We have Peter on today. Obviously, he's going to talk a bit more about what's going on overseas, but that was probably driving, and we've seen at times, both boons and gilts kind of underperforming treasuries. So doesn't even necessarily seem like it's a U.S. specific story. I also think there's a bit of a buyer strike. I think, starting off the year, a lot of these kind of would-be dip buyers, your big real money type of investors are probably a bit slow to get started in the year, and probably aren't interested in catching the falling knife, particularly in the first few weeks of the year. And also, that's probably where you have these kind of nebulous concerns around what Trump's policies are going to look like, deficits, inflation. Maybe that's kind of circling around inside of that buyer strike, and just one more, providing one more additional reason for would-be buyers to kind of sit on the sidelines for the time being. Lastly, I would just say that this kind of focus on term premium. I think the reason we're steepening is just because we have priced out about as much cuts as the market's willing to price out. The market's not really willing to start thinking about hikes at this point, and so the front end has been kind of capped. And so when we get positive data, when we get hawkish Fed developments, and there's a selling pressure coming into the market, that's hitting the back end a lot more than the front end, because we have the front end kind of pegged, at these levels, because the market's just not really ready to kind of go into thinking about the potential for hikes yet. So that's what I think's been kind of driving the steepening aspect of that.
Blake, can I return to the deficit that you just mentioned? And is there a risk to U.S. economic exceptionalism from potential fiscal tightening? Some budget hawks in the Republican Party are already making some noises. What's the likelihood of meaningful U.S. fiscal tightening in the coming term, and what would be the implications for Fed policy? Or if I can put it differently, how much of the U.S. economic strength is actually fiscally driven?
So I do think fiscal has been an important driver of some of the strength that we've seen over the last few years. But I do think it's a part, not the only part. There are other reasons coming out of the pandemic that I think rate hikes haven't had as much downward impact on the U.S. economy. Fiscal being one of those, but as I said, not the only factor. Now the question is that going to shift going forward? At least not in the near term. I am somewhat glad that this is not a visual medium, because I'm sure I make some involuntary facial expressions when asked about Doge and the likelihood of cutting budgets. I just don't see a realistic scenario where we're meaningfully cutting down on the spending side. When you kind of take off, interest payments, Social Security, Medicare, military spending, things that are very unlikely to be touched by Doge, you're really left with probably less than 20% of the actual budget that's even up for debate. And even when you get inside of there, you're going to find that a lot of the big areas of spending do have very passionate constituents behind them. You think about something like Department of Education that sends out Pell Grants to help kids go to college. Are we going to cut that spending? So any kind of thing you start trying to carve, there are people that start showing up and saying, no, you can't do that. So I think their actual ability to cut down on spending is probably very limited. And at the same time, deficits over the next year, at least for the remainder of this fiscal year and probably into next, are going to remain very, very large. And I think fiscal is going to remain in an accommodative stance.
Okay, that makes sense. But as a follow-up then, so if it's not the fiscal side, what other potential dovish risks do your forecasts are out there? Or put differently, under what scenario do you see the Fed cutting again?
I mean, to me, the dovish scenarios all come down to tariffs and trade war. That is the big risk. That is the big X factor for 2025. If we're sitting here at year end telling a negative story, or the Fed having cut 4 or 5 more times from here, or even 2 or 3 more times, I would be willing to bet that the reason is tariffs. If we get into a large trade war, tit for tat, counter tariffs, and starts to drag on growth, drag on sentiment, that's the major downside risk, I think, to our forecast at this point. So let me kind of turn that a little bit around on you, Peter. And I'm going to kind of flip the nature of the question, just because everybody's, it makes sense you're asking me about dovish risks, because we do have this theme of kind of U.S. exceptionalism going on. But so I'm going to flip it on the European side. Everybody's very bearish on Europe. Can you give me a bullish economic case, or maybe, I guess, hedge that and just say a less bearish one than the doom and gloom that I think's been circulating out in the market recently?
Yeah, I think your hedge is setting it up nicely. So let me get the first thing out of the way. Structurally, we are in a difficult position over here, and I could go on and on about the structural impediments to growth in both the euro area and the UK. But leave them aside for a second. I do think the marginally more optimistic case can be made from the cyclical side. In fact, we just put a note out highlighting 5 areas where we think growth could potentially surprise slightly on the upside. And without going into any one of those, the big one that I would highlight is just personal consumption. Personal consumption has been so weak over the last couple of quarters. And one of the things that we've seen is despite an increase in wages and real wages, we've also seen an increase in savings. And if that just normalizes, halfway back to historic levels, I think we should see a positive contribution from personal consumption here. But there's other reasons, of course, and that we cyclically could surprise, as you said, a very, very downbeat consensus. And I think that's actually sort of the point that we're highlighting the most. That the consensus is so negative that the hurdle is very low to surprise from the cyclical side.
So I guess if we kind of assume that we actually do get some of the downside risks on growth side over there, but we have this kind of upside pressure on inflation that you're kind of hinting at here. But what does the ECB do? I mean, I guess part of this is coming from the experience on the U.S. side where we have a dual mandate. But given the single mandate, are they going to respond to downside growth, or are they going to choose to attack more the upside inflation risks?
Well, I think the answer here must be a little bit of both. And what they've done so far is they've obviously cut interest rates from levels that were restrictive. They're still in an environment where they say it's restrictive, and they have indicated that they want to bring it back to neutral. Now, we can have a debate about where neutral is, but one of the things where I think it would become really interesting as the year progresses is once we get into that neutral zone. Lagarde has mentioned 175 to 250, so 2 more rate cuts, and we're at the top end there, is how far down can they go? Because one of the things that we see playing out over the course of the year is that because of these structural impediments that basically lower our trend growth, even relatively small surprises to that reduced trend growth will be inflationary. And now our labor markets remain very tight. And if inflation just remains sticky, then I can see the ECB stopping at levels before we reach the area that the market is currently pricing for. And I think, for market terms, in my mind, that is the risk for the bond market, that we simply do not get enough rate cuts compared to what the market has been pricing for quite some time. Now, we've priced out some of that already, but I think the risk as the year progresses is that we price out even more.
So one of the big talking points in the U.S. has been term premia around deficits and supply. Gilt yields are rising, specifically the 10-year point, pushing to new highs above the levels that we've seen during the Liz Truss budget drama. Peter, are the bond vigilantes sniffing around the UK again, and how serious is the situation?
Yeah, so the first thing, thank you, Jason. The first thing I would say is that the situation, in my mind, is not comparable with the Liz Truss drama, as you put it, at all. Because back then we had a self-fulfilling loop of higher bond yields and position squaring, and higher bond yields and position squaring. That's simply not the case at the moment. Now, what is the case, though, is that, as you say, we've seen a fairly significant rise in bond yields. And what we also see is that there is talk again about the sustainability of the fiscal situation in the UK, and a closing of the self-imposed gap between what the government has said is acceptable or not, the so-called fiscal headroom. Now, there is now talk that the government probably in March would revise its spending plans. That's probably going to happen in the later years, but the perception in the market is that the government has to respond now to the increase in bond yields that makes carrying the debt more expensive. And what we reckon, when I look at the market more broadly, is that this rise in term yields will ultimately is ultimately a fiscal tightening that will, in my mind, have to bring the Bank of England into play. And out of the concert of all the big central banks, the Bank of England has been, in our mind, underpriced for quite some time, and we're pricing not even 25 basis points for the next meeting, where we think it's very, very likely that they will cut. So I think that the front end should be supporting the gilt market going forward.
Okay, so if we had to boil that all down to, one sentence, do you think we keep pushing higher in yields, or do you think bearish sentiments become, so extreme at this point that we're nearing an end?
I mean, I personally think that the risk is still that we push to the upside, maybe more so in euros than in sterling. But as Blake was also saying earlier, it's a concerted global move that we've seen, and in my mind, in Europe, we're still not nearing the end just yet. Jason, let me do the same to you that Blake did earlier. Let me turn the tables and ask you a question then. So a big piece of the 2025 outlook that you put out is the big divergence in yields between the US and Canada. And as Blake has now changed his already hawkish terminal call last week and doesn't see the Fed cutting anymore this year, and actually is promoting that there might be a hiking bias coming into the market at some point this year. So if anything, how are you feeling about your end? Divergence is still on?
Yeah, I think given the current state of affairs, it still makes a lot of sense. 2% BOC terminal rate, which is below the market, below consensus, that remains our call. And at the end of the day, the Bank of Canada has shown a willingness historically to diverge from the Fed at different points in time. And macro conditions have been vastly different the past 2 years, and that should remain the case in 2025, given the numerous headwinds that are facing the domestic economy. We think the currency, that won't stop them from cutting unless it really decouples from fundamentals, or if there's some material risk premia or sentiment premia that starts getting attached to it. And ultimately, the inflationary consequences of the currency depreciation that we've seen so far have been very, very minor. And in historical periods when we've had a very big currency move or depreciation, the Bank of Canada has tended to look through that. I would say the exception, what a lot of people talk about, is the 1998 crisis scenario that happened in Russia, Asian currencies with long-term capital management. But those were acute FX contagion risks, and the BOC had to respond very differently than it has in other episodes when the currency's been falling. So, in general, currency not that big of a deal, and the macro conditions are very supportive of that divergence theme. Now, I would say that the general fly in the ointment is tariffs, and there's a lot of uncertainty, and they could cause the Bank of Canada to pause, do less in the short term during a period of uncertainty. But ultimately, on the end of it, it might require them to cut more than otherwise, assuming that the negative growth consequences are greater than the inflationary ones. So further divergence is still on the table over the medium term, in our opinion, under various scenarios, and the market's mispricing it, we think.
Jason, whilst I've got the floor here asking questions, we're also heading into an election campaign in 2 months' time in Canada. And from a market perspective, what are the potential implications or scenarios that we need to watch out for? How could it impact the market?
Yeah, there's definitely a lot of noise and uncertainty right now. And I think first we kind of need to figure out who's going to be the Liberal leader. It seems like it's coming down to a 2-horse race between Carney and Freeland. And then we need to, see if either can get, one of the minority parties, the NDP, for instance, back on side in order to delay an election until October. Right now, May and June does seem like the most likely time period for an election. But with U.S. tariffs, there is a possibility that that could get pushed out further. And the third thing we need to think about in the bigger election picture is that the Liberals are well behind in the polls. And it's a major uphill battle, I think, to change public sentiment in a short period of time. It's not a 0% chance, but it's definitely an uphill battle that they face. And if we stuck with the status quo in the polling, a conservative government could be net positive for the economy, less tax, less spending, maybe a little bit more business friendly, and potentially a more productive negotiating partner with the Trump administration, simply from the fact that they're on the same side of the political spectrum and they share some common ground on some different bigger picture issues. But it's messy and noisy now, especially with the looming tariff threat. But, staying focused on the big picture, there could probably be a more conducive environment for the economy, maybe general fiscal tightening, balanced budget earlier. To be honest, the implication for bond yields, for what happens with different election scenarios is probably pretty modest as far as how it would impact the supply picture.
So Jason, you mentioned tariffs just a second ago. I'm a bit curious because I've been pretty sanguine on the U.S. side about tariffs. I think Trump's bark generally going to be worse than his bite, but I get a lot of pushback from colleagues and clients, particularly in other regions. Just given that I think some of our major trading partners don't really have the luxury of just assuming that this is going to be kind of a best case outcome. So I guess my question is, from your side, on a scale of let's say 0 to 10, how much angst is there in Canada about Trump tariffs, and how much of that angst do you think is already priced into the markets at this point?
So my level of concern is increasing for sure. Even if Trump takes a slow and graduated approach, the path for both economies to successfully navigate the negative economic fallout, that path is very narrow. But I would say in the rates market, most people haven't expected or pre-positioned for across the board tariffs. Rather, it seems like the vast majority of people are taking a wait and see approach. The rate story is complicated from a timing perspective. It's fair to say that over the long term, if there are large and sustained tariffs, that the Bank of Canada probably has to cut more and rates are lower than otherwise. But the short-term interplay between inflation dynamics and negative growth consequences, that could create a situation where the central bank wants to take a wait and see approach, wants to pause for a period of time before reacting to that. So you could have a period where rates are more stable or possibly even move higher. But I would say the upside in yields, at least in Canada, is very limited at the front end because rate hikes are an unlikely response to tariffs going forward. So the general bias should be rates stable to lower, and it really comes down to a timing issue.
Yeah, thanks for that, Jason. So I guess kind of a different flavor of a similar question to Elsa. It appears on the dollar side, USD is going from strength to strength. What do you think's driving that? I mean, is this US being strong? Is it the rest of the world being weak? And how much of that do you think is related to this threat of Trump tariffs?
So this is the question on everyone's mind at the moment, particularly as we get closer to inauguration. And I think if you look at the market reaction to both the Washington Post article last week, the one suggesting tariffs would be limited to targeted sectors, and then again last night, so that proposal for low tariffs, which rise incrementally, both show that there is clearly some kind of tariff premium in FX markets, as both times we've seen a bounce in pretty much every currency against the US dollar. But everyone we speak to wants something more precise than that. And this is not an exact science, but here is what we can do. We've got a fitted framework we use to understand dollar CAD in particular and decompose its returns across its main drivers. So that's rate differentials, equities as a proxy for general risk appetite, crude prices, general dollar direction. The residual on that model captures factors outside those usual drivers. And in this case, it can offer some measure of a tariff premium. So as things stand, we estimate there's about 0.5% in the price for dollar CAD at the moment. Dollar CAD is 0.5% higher than it would otherwise be. That tariff premium has been as high as 1%. It's fluctuated quite a bit. It's not huge. There is, however, another powerful driver that's been pushing the US dollar higher. Since the election, we've spent about a third of the time with bonds and equities selling off together. And this is a regime we'd not really seen since 2022. Notably, that is also the last time Eurodollar was trading below 102, the last time the dollar index was above 110. We actually recently published a chart of the day on this, which delves into it in more detail, but the high-level summary is this. In the weeks where bonds and equities have been selling off together, that accounts for about a third of the time since the US election, but it accounts for 2/3 of the dollar's 5 to 6% rally. So if bonds and equities are selling off together, this points to further dollar gains, even if positioning is pretty stretched. If, however, equities bounce, whether or not yields are marching higher, dollar gains are likely to be capped, and moves in Eurodollar, for example, sub-parity would be hard to sustain. So now, clearly there are some short-term risks around that. I tend to agree with you, Blake, that Trump is more focused on using tariffs as threats rather than actually wanting or being willing to stomach the potential economic pain. But that's not to say we won't get some tariffs, likely more than his previous administration, but well short of what was promised on the campaign trail. And I feel like current market pricing is somewhat reasonable for where we eventually settle. But to Jason's point, we're likely to swing back and forth. We've spoken to clients out there who expect universal tariffs on day one. And clearly, even if you don't get tariffs being implemented, it can have an impact on economic activity, both through consumer sentiment and business investment. So not much in the sense of tariff premium baked into FX at the moment. Clearly potential for more noise around that, particularly post-inauguration. But as time goes on, and if universal tariffs are not implemented, the impact of incremental threats is likely to diminish.
So given all those factors, where do you think USD positioning is right now? Like, where are we in kind of that process, and kind of where are investors, how much of that has been basically put on by investors?
So long dollar positioning is undeniably crowded. But to put some numbers on that, we have a positioning monitor that looks at observed market trade data. And then using a model, we extract positioning signals from that data. So this is not just RBC flow. And on that monitor, long dollar positioning on aggregate is currently sitting around 80% of the largest ever net long position. It is rare that at an aggregate level we get to such stretch levels. And again, to give it some context, the last time we were at these levels of long dollar positioning was in October, November 2022, on the back of that big wave of dollar buying that had come following the twin bond equity sell-off in the third quarter of that year. In individual currency pairs like Eurodollar, like dollar Swiss, the long dollar positioning is even more crowded. I mean, dollar Swiss and Eurodollar earlier this week have kind of maxed out with the largest long dollar positioning we've ever seen in the last decade. Now, that's not to say it can't get larger still, and it absolutely can. Just referring back to the comments I made previously on tariffs, if we were to see much more aggressive tariffs being implemented by the Trump administration, clearly we could see the dollar appreciate further from here and long dollar positioning grow further from here. But it does highlight the fact that the market is pretty well priced for a lot of the strong US data, US exceptionalism, hawkish Fed, or much less dovish Fed, however you want to think about it. And so it's not an unsustainable equilibrium because the carry on holding a long dollar position is mostly positive against most other currencies. But it does mean that if anything happens to upset that equilibrium, whether it's signs of weaker US data or it's a bond and equity rally that happens in parallel, that could cause quite a sharp reversal in the dollar. I think that's what keeps investors nervous and maybe not wanting to add to longs at current levels. Let me finish with one final thought, which is particularly relevant to those hedging FX exposure. And I've had this conversation with some of our large corporate clients. At the moment, I'd say the probability of a 5% move higher in the dollar is still higher than a 5% move lower, primarily because, as I said earlier, there's not a huge amount in the price in terms of a tariff premium. And if the incoming Trump administration comes out the gates a lot more aggressive than markets are priced for at the moment, you could see quite sharp market reaction, even if ultimately those tariffs are not implemented in anywhere near that scale and size. But just bearing in mind valuation, positioning, the starting point, from my point of view, the probability of a much bigger move, so say a 20% move higher in the dollar, is far, far smaller than the probability of a 20% move lower in the dollar. Now, you'd need things to change quite materially in order for moves of that size to happen. You'd need a real turnaround in the US data. You'd need a substantial repricing of the outlook for the Fed. But I think it's just some helpful context when thinking about the balance of risks around the dollar at the moment. Positioning doesn't need to correct. It doesn't need to turn around right away, but it does mean that if the underlying conditions change, there's potential for a far bigger move to the downside in the dollar than perhaps there is for the upside.
Elsa, we have seen euro weakness versus the dollar, but even more so, we've seen sterling weakness, including versus the euro. So what's your take on sterling?
So what's going on in sterling at the moment is really interesting because some people have pointed to it as evidence that the situation in the UK is far worse than people are talking about right now. The fact that sterling has been underperforming as much as it has over the past week. But I think positioning actually plays a big role in this and how sterling has performed. If I rewind a week ago, positioning in sterling was actually long on the crosses. So the market was short euro sterling, and it was pretty light even against the dollar. I've said markets really long dollars across the board, very crowded in short euro dollar, very crowded in long dollar CAD, long dollar Swiss, long dollar yen. But positioning in cable was actually on our metric only net short around 20 to 25%. That has obviously changed in the past week. That short position in cable has more than doubled. And we have seen the market flip from being net short euro sterling to being small net long. But it's the fact that the market was so underpositioned in sterling or wrongly positioned on the crosses, which I think has really reinforced the underperformance of sterling over the past week. So looking ahead for sterling, we have seen some pretty sharp moves over the past week and a swing in positioning, but it remains lighter than the short positioning in other currencies versus the dollar. And as I said before, euro sterling has flipped to net long, but it's not a huge position by any means. Now, Peter mentioned earlier that the Bank of England may be forced into cutting more than is priced by the market at the moment. And it is a bit of a regime shift for sterling because up until the tail end of last year, it was really being treated as a pretty good carry trade, a high yielder, relatively low volatility on the crosses in G10. And so you may well see some more of that pressure feeding through. We do actually have short sterling CAD as one of our thematic trades for 2025. And it's a trade which over the course of 12 months, I really like.
So given that we are a Canadian bank and I am a U.S. strategist, I just have one last question that I would hate to not ask you, Jason. When Canada becomes the 51st state, which NFL team are you going to support?
Well, Blake, one, we have our own brand of football up here, the CFL. We don't need an extra down, just a bigger end zone. But I guess if I had to, actually pick a U.S. team, I'd have to say, I've been a long time Bills fan and supporter. I know you're a diehard Chiefs fan, but I do think this is Buffalo's year.
As a Kansas City guy, I just can't support that answer. But thanks for giving it.
Thank you, everyone, for joining this episode. If you have further questions, you can reach out to us directly or via your sales coverage, or visit RBC Insight to read our content.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.